The day the paper promise breaks. Why gold and silver outlive every currency that has ever existed. What if I told you that the money sitting in your bank account right now is not wealth at all, but a promise, and promises, throughout the entire span of recorded history, have an unblemished record of eventually being broken? There is a peculiar kind of confidence that settles over a society in its most comfortable years, a confidence that mistakes habit for permanence. We have grown so accustomed to paper currency, to the crisp bill, the glowing balance on a banking app, the abstraction of a number that represents nothing but itself, that we have stopped asking the only question that has ever mattered to civilizations on the brink. What, precisely, is this money actually backed by? The answer, uncomfortably, is nothing but agreement. A shared fiction, a government's word, and the willingness of strangers to keep believing it. This is not a new observation, though it is one each generation seems destined to relearn the hard way. Every fiat currency in the history of the world, every single one, without exception, has either collapsed outright or been quietly, relentlessly diminished. The dollar is no exception to this rule. It is simply further along in the process than most people realize. Since the founding of the Federal Reserve in 1913, the dollar has surrendered something on the order of 90% of its purchasing power. Let that figure sit with you for a moment. 90%. Not stolen in a single dramatic heist, but extracted in increments so small, year by year, that no single theft was ever large enough to provoke outrage. This is the particular genius and the particular cruelty of inflation. It does not announce itself. It does not break down your door. It simply, patiently, makes the dollar in your pocket worth a little less tomorrow than it was worth today, and asks you to call this normal. We have a word for this slow erosion, inflation, and the word itself has become part of the deception, because it sounds clinical, manageable, even routine, like a weather pattern central bankers have learned to forecast and tame. But strip away the technocratic language and look at what is actually happening. A small number of institutions possess the unilateral authority to create currency from nothing, and every unit they create dilutes the value of every unit already in your possession. It is, in the most literal economic sense, a transfer of wealth from those who hold cash to those who control the printing press. And it has been happening, quietly, to every generation that has ever trusted paper money as a store of value. History does not deal in hypotheticals here. It deals in case studies, each more sobering than the last. Weimar Germany in the 1920s, where citizens burned banknotes for warmth because the wood was worth more than the currency. Zimbabwe in the 2000s, where a loaf of bread eventually required a brick of trillion-dollar notes. Venezuela in our own recent memory, where pensions evaporated and savings accounts became cruel jokes almost overnight. In every one of these cases, the underlying economy had not vanished. People still possessed skills, still produced goods, still showed up to labor each day. What collapsed was not productivity. What collapsed was trust in a piece of paper that had been issued without restraint. And once that trust broke, it broke completely, and it broke fast. It is tempting, comfortable even, to regard these as foreign tragedies, distant cautionary tales that belong to unstable governments and unfortunate continents. But the conditions that produced them, unrestrained monetary expansion, governments addicted to deficit spending, central banks papering over structural rot with newly conjured currency, are not unique to Weimar or Caracas. They are, in fact, the defining features of the world's major economies at this very moment. The names change, the mechanism does not. And so we arrive at the uncomfortable truth that history has tried, repeatedly and patiently, to teach us. Paper money is not wealth. It is a claim on wealth, contingent entirely on the discipline and honesty of the institutions that issue it. Institutions which have, time and again, proven themselves neither disciplined nor restrained when the political incentives point toward printing rather than reform. Gold does not share this vulnerability. Silver does not share this vulnerability. You cannot conjure an ounce of gold into existence with a keystroke at a central bank. Its scarcity is not a policy decision. It is a geological fact, and geological facts do not bend to the convenience of finance ministers facing an election. This is why, across every civilization that has ever used money, Roman, Byzantine, Ottoman, British, American, gold and silver have outlived every paper currency issued alongside them. Not because of superstition or nostalgia, but because metal cannot be inflated away by a committee. It carries no counterparty risk, no dependence on a government's continued solvency, no vulnerability to the political pressures that inevitably corrupt a printing press over a long enough timeline. While currencies are born, devalued, and eventually retired with almost predictable regularity, gold has held its purchasing power across millennia, in a way no paper instrument ever has. None of this means collapse is imminent on any particular Tuesday, and anyone who tells you they know the precise date of the next crisis is selling you something other than honesty. But the structural pressures are not in dispute. Record sovereign debt loads, persistent deficit spending, and central banks that have spent more than a decade treating monetary expansion as the default answer to nearly every economic problem. These are not conspiracy theories. They are visible in public debt figures, in central bank balance sheets, in the plain historical pattern of what happens when currencies are managed this way for long enough. The question worth sitting with is not whether paper money has weaknesses. History has already answered that question, repeatedly and without ambiguity. The question is what you intend to do with that knowledge while there is still time to act on it, rather than simply react to it. If any of this has unsettled you, good. Discomfort is often the first honest signal that complacency has worn off. Before we go further, if you want to keep thinking clearly about where real value comes from, rather than being lulled back to sleep by reassuring headlines, this is exactly the kind of conversation worth staying close to. Subscribe now because the next part of this gets even more urgent, and I don't want you to miss where this is headed. There is a particular kind of danger that does not announce itself with sirens. It arrives instead through gradual normalization, markets climbing to records that feel earned rather than engineered, governments borrowing at a pace that would have seemed reckless a generation ago, but now barely registers as news. Central banks intervening so routinely that intervention itself has become invisible, simply mistaken for the natural order of things. This is precisely the condition that precedes every major financial reckoning in history. Not chaos, but a deceptive calm that lulls even careful people into believing the rules of gravity have been suspended. Consider the architecture currently propping up the global financial system. Stock valuations sit at levels historically associated not with extraordinary corporate performance, but with extraordinary monetary accommodation. Trillions of newly created currency searching for a return, inflating asset prices in the process. Bond yields for years were suppressed to levels that bore little relationship to the actual risk of lending to governments carrying historic debt burdens. Sovereign debt, across nearly every major economy, has reached levels once considered the threshold of crisis, and is now treated as an unremarkable footnote. None of this is hidden information. It sits in plain view, in public records, available to anyone willing to look past the reassuring tone of quarterly earnings calls. What makes a financial shock dangerous is rarely the event itself. It is the interconnectedness of a system that has spent decades optimizing for efficiency over resilience. A debt crisis that begins in one region no longer stays contained to that region. A banking failure in one jurisdiction ripples through correspondent banks, pension funds, and sovereign wealth holdings on the other side of the planet within days, sometimes hours. The same globalization that delivered decades of growth has also built a financial nervous system so tightly wired that a single severed connection can send a shock through the entire body before anyone fully understands what triggered it. And when that shock arrives, it rarely behaves the way people expect. The instinct is to assume cash is the safe harbor, the asset you retreat to when everything else turns volatile. But cash itself is the very instrument whose value depends entirely on continued confidence in the issuing government. In a genuine currency crisis, cash does not protect you from the storm, it becomes part of the storm, losing purchasing power in real time as confidence erodes, and prices for everyday goods adjust to reflect a currency that buys less than it did the week before. This is the part most people never see coming, because they have spent their entire financial lives in a relatively stable monetary environment, and have no lived experience of what a genuine loss of confidence in a currency actually feels like from the inside. They assume that because the system has held together for their entire adult life, it is structurally sound rather than simply unbroken so far. But unbroken is not the same as unbreakable, and the historical record is unambiguous about what eventually happens to monetary systems built on expanding debt and expanding currency in tandem. The most unsettling feature of an interconnected, debt-saturated system is how ordinary the warning signs look right up until the moment they don't. Layoffs that seem like routine corporate restructuring, bond auctions that draw slightly less demand than expected, a modest uptick in borrowing costs dismissed as a temporary anomaly. Individually, none of these events look alarming. Collectively, across history, they have formed the early architecture of every major financial dislocation. The small cracks that precede the larger fracture, visible only in hindsight to those who weren't paying attention in real time. This is precisely why diversification within paper assets alone offers less protection than most people assume. Spreading risk across stocks, bonds, and cash feels prudent, but if all three categories are ultimately dependent on the same underlying currency and the same overstretched system of government debt, true diversification has not actually occurred, only the appearance of it. Genuine diversification requires holding something fundamentally outside that system, an asset whose value is not contingent on a government's continued ability to service its debts or a central bank's continued willingness to print its way out of trouble. Gold and silver occupy that category uniquely. They are not claims on anyone else's promise. They carry no counterparty risk, no dependency on a bond market's confidence, no vulnerability to a single afternoon of panicked selling in an over-leveraged system. Their value does not require a government to remain solvent or a central bank to remain disciplined. This is not a romantic or sentimental argument for precious metals. It is a structural one, rooted in exactly the kind of risk that paper assets, by their very design, cannot escape. The historical pattern is consistent across every era of monetary stress. As confidence in paper currency erodes, capital does not simply vanish, it migrates. It moves toward assets that cannot be devalued by decree, assets whose scarcity is enforced by physics rather than policy. This migration tends to happen quickly once it begins, often catching unprepared investors trying to buy protection at prices that have already adjusted to reflect the very crisis they failed to anticipate. Preparation, in other words, is not something that can be improvised in the final hour. It has to happen while the system still looks calm, precisely because calm is when protection is still affordable. None of this is a prediction of a specific date or a guarantee of a specific outcome. No one, regardless of credentials, can honestly claim that level of certainty about financial markets. What can be said with confidence, grounded in the historical record rather than speculation, is that systems built on expanding debt financed by expanding currency have never, in the long run, ended quietly. The only open question is one of timing, and timing is precisely the variable that rewards early preparation over late reaction. There is an old and stubborn misconception that gold and silver are relics, collectibles for hobbyists, or a defensive trade reserved for the moment a crisis has already become undeniable. This misunderstanding is not merely incomplete, it is, historically speaking, backwards. Precious metals have never functioned as a reaction to crisis. They have functioned as insurance against one. And insurance, by its very nature, only works if it is purchased before the event it protects against, not after. Consider what gold and silver actually represent in the architecture of an economy. They are not bets on a company's quarterly earnings or a government's ability to manage its books responsibly. They are not claims that depend on someone else honoring a promise. They are tangible, scarce, and finite, qualities that cannot be replicated by a policy decision or a vote in a legislative chamber. While the supply of dollars, euros, and yen can expand at the discretion of a committee, the supply of gold is constrained by what can actually be extracted from the earth, a constraint no central bank has ever managed to override. This distinction matters more today than it has in decades, because the conditions that have historically preceded currency devaluation, persistent deficits, expanding debt, and central banks treating monetary expansion as a default policy tool rather than an emergency measure, are not isolated to one country. They are now structural features of nearly every major economy simultaneously. This is precisely the environment in which precious metals have historically outperformed paper assets by the widest margins, not because of speculation, but because capital instinctively seeks shelter in scarcity once it senses that abundance has been weaponized against it. There is also a psychological dimension worth naming honestly. Holding gold or silver requires a kind of discomfort that holding a number on a screen does not. It requires acknowledging on some level that the system you have trusted your entire life might not be as permanent as it appears, and that is an uncomfortable thought for anyone to sit with. It is far easier to trust the abstraction, to assume that because the balance in an account has always been there, it always will be. But comfort and safety are not the same thing, and history has shown, with painful consistency, that those who waited for undeniable proof of crisis before acting were almost always too late to act effectively. This is not an argument for panic, nor is it a suggestion that paper currency will be worthless by next week. It is an argument for proportion, for recognizing that an asset class which has preserved purchasing power across the fall of empires, the collapse of currencies, and centuries of political upheaval, deserves a place in any thoughtful approach to protecting wealth, rather than being dismissed as an eccentric hedge for the unusually anxious. The investors who have weathered currency crises throughout history were rarely the ones who acted in the final chaotic days. They were the ones who treated preparation as a quiet, unremarkable habit, long before anyone else considered it necessary. The lesson embedded in centuries of monetary history is not complicated, even if it is frequently ignored. Currencies are temporary, but scarcity is not. Governments come and go, regimes rise and fall, and every paper promise issued by every one of them has eventually been revised, devalued, or abandoned. Through all of it, gold and silver have remained what they have always been, a form of wealth that does not require anyone else's continued good behavior to retain its value. What you choose to do with that knowledge is, of course, entirely yours to decide. But the choice is rarely made wisely under pressure. In the middle of a crisis everyone can suddenly see. It is made wisely in the quiet, unremarkable moments like this one, when the system still looks stable enough that most people see no reason to act at all. That, historically, has always been exactly the moment that mattered most. If this changed how you're thinking about where real value actually comes from, I'd genuinely like to know. Drop a comment below and tell me whether you already hold any precious metals, or whether this is the first time you've seriously considered it. I read every one, and the conversation in the comments is often where the most interesting perspectives show up. And remember, this is for education and discussion only, not personal financial advice.